Guys, how are you all? It's really great to see you.
Good
Happy to be
morning.
here.
Yeah, no,
Hello there.
it's fantastic to be here talking to you today because this is a subject that is really close to my heart because I've got my own business. I've got two girls that I am battering over the head trying to get them to come and work for me with not much success at the moment. So I'm looking for ideas and advice. So this webinar, and welcome to our audience, is a practical guide for entrepreneurs and family businesses. And it's about the succession issue, which I think affects anybody in those categories, and sort of how to find your route through. So you guys are going to give me and everybody else some really practical advice today on how to approach this and what we need to do. So I'm going to start with you, Larry, because you're like me. You've been part of a family business. What have you learned over the years from this?
So let me start by telling you some of the history. So I began my career not in the family firm, and that was going really well until I got an offer, I couldn't refuse, and I came to the family firm, and the firm has certainly progressed from then. And while there are family members in the firm, the vast majority of the firm is not a family firm today, but it still retains that feel of a family, which we like to maintain. So my experience is that family business is terrific, except when it's not, and that's been my experience with across the board. And I've been in my tenure as a partner in the firm, I've advised many family businesses, as you would expect, but being able to take my personal experience, warts and all, perhaps into client advisory, I see that consistently. When it works, it's terrific. You get alignment, you get commitment that you would never find in organizations that are not family businesses.
Yeah,
but of course
they're teenagers.
But you also get family dynamics, that are there are people involved in the business that have nothing to do with the business because they're also family members. You get so there's lots of family aspects to the business that can prove very rewarding for the business, but can also be a challenge.
Yeah, no, I completely get where you're coming from. But David, can you give us a very quick overview of the key issues, and then we'll perhaps go on and look at them individually. So what are the issues that are going to come up, as well as the family dynamics that Larry's just talked about? What are the things that people need to tackle?
Okay, so, number one is, people have families, they have families at home. There's all sorts of politics that goes on at home, and someone gets married or someone gets divorced or there's a new child, and you're taking all of that stuff, let's just call it stuff, and you're taking it from the home and you're bringing into the office. You somehow lose that separation between church and state, call it, right? And a lot of the stuff that you deal with at home now can somehow fester its way into the office. So it's very important that all of the family members that work together, think at the beginning, understand that there has to be some sort of divide. If you do something to your sibling or your dad or your mom at home that they don't like, when you go to work, the office is there, there's employees, there's staff. You have to make sure that stuff, let's just call it stuff, because it could be good or bad or, doesn't actually carry in, number one. Number two is, when you're talking about, let's say, succession, somebody might think that their mom and dad's favorite son, they went to Harvard and they have the brains and everything, but mom and dad think, well, he might have all the brains. He got the straight A's and he went to the big firm or the big company. Now he's here. But the other child, the daughter, the other son, whatever, they started off doing the mail, and then they work their way up, and they don't have the fancy suits. They come in wearing jeans and the t-shirt. But the father and mother see that child as the real succession of the business. They understand. And and the other child, they think that, well, they went to school, they're educated, they might be the one. And then you have other issues about, let's say the parents want to transfer or they want to sell the business to the sons, daughters. Well, child one might think the business is worth $1,000. Obviously a bad example, $1,000. The other one might say $2,000. Then you have to figure out payment structures, payment plans, what's it worth? And a lot of that can really destroy a family if it's not done right. So these are all sorts of things that have to be looked at in advance, because as important as a business is, family, most people would say family is more important. And these issues all have to be addressed, no question.
Joe, I'd never even thought about selling the business to my kids. That's really helpful.
Yeah.
So,
retirement is not cheap. Retirement isn't cheap. You know?
No, and they drains me dry.
Yeah. Number two, if there's multiple children and one is successful, then how do you compensate the other ones if the family business is the primary asset of the family?
Yeah.
So I think that you end up having to put a value on that business at the time that it's passed, and that value may not go to only a portion of it may go to the parents. Ultimately, it's going to be shared amongst all the children.
Yeah, that's a really good point. I hadn't even thought about that. So that actually opens up the whole discussion about who needs to be involved in that succession planning, because if you've got children that are sort of maybe not sure about who's going to be the main person taking over, you've got to talk about the value. If you leave people out, there's going to be arguments, aren't there? So who do you feel, Larry, should be involved in that conversation?
Well, the first is to go to the professional advisors that know the business, that know the personalities, if they have the ability to be able to do that, because you have personal sides to it, you have valuation sides, you have tax sides, legal, all of that. So you need to assemble a team of people who can do it effectively. And if they're people who know the personalities, it's certainly going to work better. But if they don't know the personalities, then you bring in people who understand the dynamics of family business and succession, and you build a team that will deal with all of those aspects.
Yes, it's about getting those right people around you. I suppose that also with the valuation as well. You need to be sure that our valuation is correct, because it can cause awful arguments, can't it? Like you were saying, one thinks it's 1,000, somebody else thinks it's 2,000. Oh, it's just a minefield, isn't it?
One thing I would also add in there is that obviously you have to get in the accountant, and if there has to be lawyer and all that stuff involved. But I think at a very early stage, I think the parents should be having conversations, or the owners of the business should be having discussions. The dialogue should always be going on. They should get a feel of what the different children or whoever they share the next intergeneration, it should be discussed. So people should have time to think about it, what their roles are, what they want. Sometimes, the parent decides, March 1st that they, want out, and they spring this massive decision on the kids that, or I say the kids, but whoever it is, and no one really has time. Like if you have a family business, there should be discussions. I'm not saying you have to sit down at dinner and just discuss the family business. You shouldn't do that. But you should get a feel for what different people want, because these are decisions that should be made over years, I think, as opposed to just months. Sure. So if parents are thinking about giving the business over, I'm not saying selling it, they can transfer it, they can do a freeze, there's all sorts of tax stuff. But the conversation should be flowing so the parents could nip in the bud, if possible, potential issues that they might see.
Those discussions
that's good.
Very challenging. Very, very challenging.
It's a good point, but I think that the way to build up to that is I like the idea of private companies having annual meetings if there's multiple stakeholders in the business. So if you have a bunch of kids, some of whom are involved in the business and some aren't, but again, the business forms the largest family asset, or perhaps, then the idea of, because as the kids become adults, and they should be aware of what's going on in the business, what the plans are, how the business is performing, rather than just having to speculate, because inevitably the kids are going to be speculating, especially if some are involved in the business and some aren't. The idea of creating having an annual meeting where there's presentations on the financials, a discussion, a report by the CEO, or whether they're in the family or not in the family, on plans for the business, what happened in the last year, that sort of thing, treating the family members as if they're shareholders.
I think that's an absolutely excellent idea, because one of the things that I'm really aware of as a business owner is that people have a very strange idea about sort of how much your business is worth, how much you're earning out your business, what cash, and the difference between cash flow and your end of year accounts. It's a really big difference. So actually, to educate your children that aren't involved so that they understand business and how you run it is a fantastic idea. So, I mean, David, I struggle with cash flow. It's I'm a marketer. That's what I do. I'm doing those spreadsheets and all of that for me has always been something I haven't enjoyed, and I'm sure I'm not alone in that. There's many entrepreneurs out there. We're too busy doing the stuff. You don't want to spend the time looking at the numbers. So, how do you? For me, I can't imagine how you would address the cash flow and all the financial planning aspects and sort of handle that over and involve the kids or whoever is taking over.
Yeah.
How do you go about all that? It just seems like a very big, difficult problem to me.
For sure. Education, I think, is key. People often don't know the difference between profit and cash flow, right? It's a very basic thing. I could have sales of $1 million, but that means I have sales, I have profit. Hopefully I profit on the sales. But if I'm not collecting, if the receivables, if I send out invoices and I'm not getting paid, it's very nice. I have all this income and I can have financial statements and say I made this money, but there isn't cash, right? So it's, I think that the family members, to the extent possible, they should be educated. I'm not saying they have to go to school to understand, taxes and accounting, but it's very key that cash flow doesn't necessarily equal profit. And as long as they understand that, just because they see their earnings, they made, millions of dollars, it could be that they're cash poor. They could have taken that money that they made and invested it in assets. Profit doesn't necessarily equal cash. So I think the education as to what the differences are, I think it starts there.
Yeah, I think it's crucial. I found that when I started my business, that was a really difficult thing to get my head around. So I think that's absolutely spot on in terms of advice. Now, Jen, I feel like I've been neglecting you.
No, that's okay. The guys have been contributing
Jen's the best.
I'm saving her for last because, she's going to tell us everything else. So from your point of view, what are the common problems that you see within families, when they have a business and they want to sorting out these issues?
I think Larry touched on something that I think is really important, which is communication among all the stakeholders in the family. Oftentimes people keep things close to the vest of the information, and it creates challenges as you go forward. The guys got into a little bit more of the details, but if you sort of fly up, in terms of family dynamics, I sort of see three different bigger scenarios when you have one child who's key in the business, part of driving that growth and that value driver in the business, and then the other kids who are not involved, and the family business is a key asset. How do you equalize is a big challenge. And how do you deal with the dynamics among the siblings in that the one child who's driving the business feels like the others are getting a ride from him and building the value in the business, and vice versa. He or she got the opportunity within the company. So there's a big dynamic that can be driven there, that regular annual meetings with all the stakeholders could be extremely valuable. Other scenarios that I think can be even more challenging are when kids are in the business, but the parents feel none of them are capable of stepping into their role. Those can be hard conversations, and even harder if there's a niece or nephew that can. So these things can be hard discussions, but having regular meetings, letting people know what the various individuals are contributing on a monthly, annual basis, I think can bring more consensus around the table. And then another dynamic that I'll finish up on your question is more and more people are having children later in life. And so they're nearing retirement. They've got this lovely business, and the kids like yours, maybe teenagers or early 20s. So what do? Do you hang on and you continue working when you may be ready to retire in the hopes that you can pass it on to your kids? Will they even have an interest? And these are some of the ebbs and flows that family businesses face.
Yeah, I mean that whole sort of idea of you getting to the end of your life and not having solved this problem, and then suddenly somebody inherits a business. I mean, I've not really thought about that, but I mean, how did that pan out?
Sometimes parents do transfer it down to their kids without a formalized dollar transfer or sale, because they've put enough nuts away, I guess, or steaks in the freezer such that they can. But for tax planning purposes, you're going to have to pin a value so you can formally transfer that ownership. And that's when Larry and David come in to help with that tax planning. What my team does is helps pin a value on that business for that tax planning. And we can support clients in coming up with different mechanisms to pull some of the capital out of the company if that's something that parents do need. There's many different paths that can be taken to support that.
Yeah, but basically leaving it to the last minute and sort of popping it in your will or something is a no-go.
Yeah.
It's like an utter disaster area, isn't it? Because you're not really helping anybody by doing that, are you? It's that planning that's so important.
That's probably, I think, the biggest mistake
ever.
that families make. Not sharing,
and
not talking.
I could see that. So
that touches on another issue. And when we talk about these annual meetings, the concept of transparency. Often the patriarch is keeping everything close to his chest. He's not sharing information. I think a key component of these, if you're going to do the annual meetings, is an opportunity for questions, where you're open to your kids and family members about sharing information about the business. And if it's, I understand it's a tough nut to crack. People are very uncomfortable with it, but people have to recognize mortality. They have to recognize they're going to get older. People get ill. It's so important that that information is shared early, and it's shared with family members who are not necessarily part of the business.
It's hard though. Sharing your financial information is a very challenging thing to do, but an important one in a family dynamic. The
professional advisors have a role. They have a role to convince the patriarch that he should be sharing information, because if he doesn't, the transitions are not going to go well. There will be information lost. There will be antagonism in the family because people don't know and they're not being told. Especially as, like I said, especially as kids become adults, we treat them as adults.
Yeah.
Somebody once said to me very wisely, "It's a terrible thing when parents don't grow up."
That's me. That's me.
And the problem
is, they fail to recognize that their kids have become adults and they have to be treated like adults.
Yeah. But it's always the baby thing, isn't it? I mean, I've got a lot of friends as well who are entrepreneurs, and it's their baby and they like to hang on to it. And that sharing and getting stuff out of your head is very difficult. And sometimes you do it without even thinking about it. But the way I think advisors have helped me is sort of seeing that actually it helps you scale your business as well by sharing that information and bringing in advisors like you guys to actually help you make that business more standalone without needing you. So it develops more in value in actual fact. Do you agree with that?
Yeah, I would also say that my experience tells me that different cultures, like depending on the culture, some cultures, the parents, the owners don't share anything with the kids, have no clue what's going on. And that's how their culture is, and that's fine. Other ones, the bank statements are floating, around the house. There isn't anything private. And sometimes you have to kind of get over. I mean, if you want to make this successful, you have to overcome what you've been trained or how you've been taught, let's say, by your parents. And sometimes you have to share. I know certain people, they are so private, kids don't know anything. And it's one thing if your kids are 5 or 6 years old or they're teenagers. But when they're 25, 30, years old and they're relying on their parents, or their parents want them to rely on them, there needs to be some sort of conversation going. Whether it be formal or not formal, but
something.
You have to break the habits. There's a lot of habits that, I mean, I certainly have some of those habits too. I'm not, so definitely no question about it. Yeah. But you have to break certain habits in order to make this, effective. And just on that point that we kind of touched is one thing, the key rule that people don't, I mean, unless you really know somewhat about accounting and tax, is there is a key rule over here is that when somebody, if no planning is done, no planning, and someone transfers these shares, if someone built a business, and whether they pass away, so they transferred by their will, or they just hand over let's say they don't want to sell, they want to hand over, they think that they can just take their company and give it to their child. There is tax to pay. It's the government sees it as though the company was sold. So if you have a company that you started from scratch, that you just started it from scratch, and now it's worth millions of dollars, the government sees it as though it's sold. So what does that mean? With no planning, you have to pay likely a significant amount of tax, but you have no proceeds, a sale didn't happen. You didn't get any cash in. And when people hear that really never have this conversation, it blows their mind. How is the owners of the business supposed to pay the tax when they didn't sell it? And that's why these conversations are so key. You cannot just gift or in a will give over your shares to children or siblings. It's a tax disaster. And you really have to spend time thinking about it.
That's really useful information. So, Larry, for example, my two at the moment, and I'm hoping this might change, aren't particularly interested in anything to do with my business, which is a great shame, and I'm going to keep working on it. So what other options do I have? What do entrepreneurs have as options if they don't pass it on to their kids?
So the first thing is we have to divide. There's two issues. There's issues of management and ownership.
Well,
they don't necessarily have to go hand in hand. So a family can retain ownership in a business even if it doesn't retain management. It can retain management in a business even if it doesn't retain ownership. The two don't have to go hand in hand. So the first step is that the entrepreneur. I said patriarch, but these days it might be matriarch as well.
Okay.
Yeah, no question.
Sorry, ladies. It's all right.
It's all right. I'll sit in front of you, so it's fine.
Yeah. But the entrepreneur has to, needs to sit down with his advisors or her advisors and figure out what's the future, both from a management standpoint and an ownership standpoint. And then they can look at a bunch of different options. It really depends on the stage of the business is at and the stage of the successors, if there are, you can do anything. You can sell the business. You can retain the business and ownership, even when you're no longer in management, by hiring professional managers, which every business needs to do. Even if the family members are still involved in the business, they may not have the skill set to manage the business. Often the entrepreneur has a specialized skill that the children don't have. Professional services firm, for example. Engineering firms, for example. Those businesses need to be run by engineers. If the kids aren't engineers, but they know how to manage a business, they could remain in management, but you're going to need those skill sets. Every business needs to identify the skill sets. I say everybody has to be an expert on what they don't know. Every entrepreneur needs to know what skill sets at that point in time in the business are lacking, and they need to identify those skill sets and hire them. That may be the CEO.
Yeah.
Often we'll see the patriarch, the entrepreneur. Sorry, I said patriarch again. Must be the patriarchy. The entrepreneur, often will step back and become the chairman, even while they maintain ownership, and hire a CEO. All of these are options, largely depending on the state of the business. Obviously, there's much more you can do in a multi-million-dollar operation than in a small mom and pop.
For sure.
It really depends. And then David can speak to the specific tax issues. The one he identified about the importance of planning for covering the tax cost. Often the entrepreneur will pass it to his or her spouse. Whatever they own, so you defer the tax. But then when the second to die passes, this is why you see life insurance policies on second to die, because it's when the second one to die passes, then all of a sudden there's a tax bill. And if that tax bill arrives, it can be devastating. Often the children are dealing with the trauma of losing the parent at the same time and having to manage the business if it happened as an accident or suddenly. And at the same time, they're facing this horrendous tax bill. And, CRA doesn't wait. They just start, looking for collection. So David can speak to some of those tax issues. The corporate and Jen can speak to the corporate finance, the sale, the going public, which, a couple of years ago was easier than it is today.
Yeah.
These things go in waves, and you got to catch them when the opportunity is there.
And waiting for the planning until the owner passes is challenging from the management side of a business, from the sale of a business, beyond the tax, which is devastating in of itself.
I can see that. And if I wanted to sell the business, then one of the things that I'm trying to work on at the moment with my own is putting in really, really solid structures and to have a framework that allows it to grow and things. Is that going to help me when it comes up to succession planning and also looking at the options that might be available to me if my two girls aren't particularly interested in coming into the business?
Absolutely. There's different tax, just from, let's say, strictly a tax point of view, there's different ramifications on if the company is owned by you personally, if it's owned by a spouse, if it's owned by a trust, if you have a corporation that owns the shares, there's all sorts of different things. And I think you have to determine what your ultimate goals are, what you want to do with the business. If someone just incorporates a company right now, they really don't have to spend the money and the time to deal with this and set up a whole fancy structure, even if they know, because there's a chance the business, won't even make it. Most businesses don't. So people sometimes they start a business and they get way ahead of themselves. And I'm like, it doesn't make any sense to do that. But at the beginning, if you can start shortly, if you start to see there's a long-term success here, under Canadian tax law, generally you could arrange your affairs pretty early on to make that work. So structuring is very key. And just one point that on the previous thing I just wanted to kind of throw in there is all this stuff that we're talking about. We're assuming that the parents, the patriarch, the matriarch, call it whatever you want, they want to kind of give the company somehow over to their kids. But what people sometimes miss, and this is a terrible thing to think about, is what happens if it just happens, meaning that the parents own the company. They're in a plane or a bus and something happens to them. Now, you have to have plans in place, shareholder agreement, the lawyers, the trustee, that all sorts of stuff, but there should be a plan in place. If God forbid something happens unexpected, what happens there? Because people don't usually think about that. And that's something that should be, I don't know if it's part of this conversation specifically, but I just want to throw that nugget in there that you should have those plans also.
No, and I think it's really useful because I think as a business owner, you don't put all these things into boxes. It's all one big thing that you've got to deal with. So it really helps to have these different points brought out. So Jen, what's your view on the structures issue and having good structures in place? And what do you, if you go to sell, what do you need to be thinking of specifically?
So I think David addressed the corporate structure, which is really, really important to have addressed early on. When you're talking about organizational structure, a management bench is key. As Larry alluded to, if the business is many millions of dollars on the top line, you have an ability to have more layers of bench strength than you would with just a mom and pop shop. But as the business starts to grow, one of the biggest risks with that owner businesses is the reliance on the owners. So as the business grows, it's important to have all those key relationships and multiple touch points throughout the organization, customer relationships, supplier relationships. Those things are important because if the owner does get hit by a bus, you need to make sure that there's some level of continuity. And on a sale, that's one of the biggest risks that buyers look at, owner reliance. And is some of those relationships transitioned, and can they be transitioned? So from an organization structure, having a level of bench is extremely important.
And is that the sort of key things for people to do to sell, or is there anything else that I need to be thinking about?
So,
I'm writing a shopping to-do list.
I would say there's 4 big things you could think about well in advance of a sale to help one improve overall value, as well as ensure a smoother sale process. One, I've already spoken to, being management bench, but that's not just key relationships. Another key role is a strong financial person, because when you do get into the sale process, there's a lot of due diligence done and a lot of financial due diligence. So having someone with that skill set is important. Leading to that is the reporting systems. If you've well outgrown your software, your accounting software, your business software, you should look at upgrading it. One, just from business dynamic, being able to make decisions on your business and have timely information, but as well, upon the timing for a sale, buyers want to slice and dice your data many different ways, and having the ability to provide that quickly is important to keep that sale process moving. So doing that in advance. Financial statements is number 3. If you've got notice to reader financial statements, get them reviewed. An audited financial isn't required historically, but a review engagement financial statement will give a buyer a lot of comfort. And the 4th one, I would say, is get your house in order. Supplier contracts and customer contracts, I can't tell you how often I've seen them not being signed. Basic things like that, employee contracts, having signatures, having your minutes up to date, walk into your office, getting the house in order includes not having stacks of papers in the hallways. It gives a buyer comfort that the I's are dotted and the T's are crossed, that things are well looked after and they're not going to walk into a disaster. It draws a lot of comfort. So those, I would say, are the 4 big things an owner can think about in advance of the sale in the 3, 4, 5 years.
So just on that point, I just want to say, when somebody sells their business that they've spent decades building up, this is and they're going to sell it, this could be one of the largest things, in their entire life that they're going to do. And I would say 3 words, don't be cheap. Okay. I've seen deals. I mean, people are interested in buying businesses and they go in there and I'm not even going to talk about the management and all that, because all that you would hope that's, the numbers don't make any sense. No one can explain them. You send somebody, an email from the office, how come the receivables are, why is this receivable still here? No, no one answers. It takes 3 weeks to get a response. And the person considering buying, they get a very bad taste in their mouth. You want to make sure that the people there, you put people in there that are competent. And if you have to pay them more than, you have to pay a little bit more, it's worth it, because it makes a potential buyer feel comfortable and confident. And when you're cheap, I'm going to say cheap, but when you're too cheap or you don't care enough to put the right people in there, a potential buyer, they are going to be, meeting the controller and the manager, and make sure you put on a nice, don't be me, don't, look like me, put on a nice, proper, have good people there, that can respond and look polished, because that's the first impression is key. And people, once they get bad impressions, they're often done. Don't be cheap.
Yeah. My brother has a great line: cheap is expensive.
There you go. There you go.
That's really good, actually.
There you go.
And I guess if you get your advisors in nice and early to work towards that, so some years in advance, they can actually do some of that work straight away and go, well, actually, you've got gaps here and we need to sort this out. So you can get all that sorted before you get to the point where you're looking to sell. And actually, then you've built that value in with the help of your advisors. So your advisor actually improving the value of your business, essentially. Would you agree?
Absolutely.
Yeah.
Absolutely.
It's all about proper planning. That's what it's all about. You don't decide one day, okay, I'm selling the business and think that you can just, call Jan and sell business. you got to be thinking about these things well in advance, and be putting the structures in place, be organizing your business so that when you're ready to call Jen, the business is already ready.
Yeah, no, that's great. So let's move on to tax, the things that makes us entrepreneurs. We have to have a drink, a stiff drink, when we start talking about tax, don't you?
That drink's back here. If you're
excellent. Well done. Well done. Ready for
Larry doesn't, approve of the drinks that I have back here, but I'm a simple guy. I don't need anything fancy. Just give me some ice.
Excellent.
No
tax
ice.
Is very
no ice allowed.
Taxes is very, 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 very key. In Canada, if you're going to sell, let's just say that you're going to sell the business very quickly. Assuming that you own the shares personally, putting aside corporations, the general tax rate is on a capital gain is approximately 26%. There's also a rule in Canada that says, and this is where you can take advantage of it, is if your company meets certain qualifications, I'm not going to bore everybody with what those qualifications are, you could potentially get approximately the first $1 million of profit tax-free.
Right.
So that's a key thing. There's other different things if you're going to transfer the business to family or other people, called a freeze. Again, it's essentially where the parents freeze the value. The parents, whoever's giving over the business, freeze the value of the shares. There's no immediate necessarily tax consequences at that point in time, but there could be tax consequences that will come into effect over several years after. Again, I'm not beyond the scope of this call, but there are definitely options. But the sooner that you start thinking and talking about it, the more chance you have for a very successful plan.
No, that's great. So to summarize then, David, for everything that we've talked about today, what would you say, where do you think people should start and what do they need to consider as an overall summary?
As an overall summary, I think this might sound corny. Family first, meaning that don't risk family long-term, the relationships with kids and grandkids and siblings. That's number one. Once you've acknowledged that that's important and we can work around that, I would say get your house in order. They were saying, don't be cheap and, don't rush into it. Take your time, make sure the numbers make sense, the management makes sense. First impressions matter. First impressions matter. So, whether it be to your kids or to a third party, make sure everything is in order so all the information is there and people can make educated, quality decisions.
So structures and transparency and information.
Structures, transparency, and I'll say it again, you can, have a shirt that it says on my name, don't be cheap, because especially for a third party coming in, it's critical.
No, I can see that. So from each of you, what would be your one top tip to leave people with? Do you want to go first, Larry?
I've been first. So the first thing is, we've ragged on the risks of family business, but I think that we can't forget that family business can be tremendously rewarding. Working with family members can be unbelievably rewarding, not only economically from a family dynamic standpoint. The idea of passing a family business from one generation to the next generation and we can't miss the fact that very few businesses make it to the third generation. We're fortunate our business is actually in the third generation, and to some extent maybe in the fourth, but it's an unbelievably rewarding option, economically, business-wise, and personally. But at the same time, it's really important that we plan, that the entrepreneur plan, that he communicates those. And so you wanted one tip, I'm giving you three.
That's all right. I'll take what I can get. What about you, Jen?
And I would say my main tip, they've already spoken to the fact that the planning and having good advisors on your team is extremely important. And there are many good advisors. What I would say is once you've decided who to select from that are qualified, choose somebody that you can be comfortable with, that you can tell your thoughts to. that you're not afraid to speak your mind to, because it's an emotional ride. It's your family. And so it has to be somebody that not only is smart and is knowledgeable, but someone you connect with.
Yeah, a bit of emotional intelligence going on as well.
Yeah.
Yeah, definitely. And finally, David.
Oh boy. I think I already said it, but just kind of, plan this, in advance, look at all the options, and communication with all parties is key. I think communication is everything. I strongly believe that.
That's brilliant. Well, thank you so much for today. This has been hugely useful. I know there's some things I need to go away and think about now, and I'm sure other people who are watching this will as well. So if people want to get hold of you, where's the best place to get hold of you two, Larry, David? So
the bar.
LinkedIn, the firm's website, email.
Yeah, all that. What about you, Jen?
You can find me on the Zeifman's website, as well as Springbank Capital, which is the affiliated corporate finance shop with Zeifman's.
Excellent. Well, it's been great to see you. Have a really good evening.
Thank you for the opportunity. I had a great time.
Take care.
Thank you so much.
Bye.